All right, let's get into it. We're breaking down all the wild market action from Friday, November 14th. We saw big tech take a hit, some massive M&A rumors swirling around, and, well, a couple of surprising winners. Let's dive right in. You know, this right here really sums up the whole day. It was just a bundle of contradictions. You had this big sell-off in the tech sector, even for companies with good news. At the exact same time, the rumor mill was going crazy about a potential blockbuster deal in the streaming world. And then, just completely ignoring all that, you had performance footwear brands that were absolutely on fire. Talk about mixed signals. So that brings us to our first big theme, this weird disconnect you sometimes see between a company doing well and its stock price going down. I mean, this is the kind of thing that can make your head spin, and we saw a perfect example of it with Robinhood. Now, this actually happened on Thursday, but the shockwaves were definitely still being felt on Friday. So Robinhood puts out this fantastic report on their October performance, the kind of update you'd expect the stock to the moon. But what happened instead? It dropped almost 9%. So what on earth was in that report to cause a dive like that? Well, just get a load of these numbers. Total assets on their platform more than doubled year over year, up 115%. Crypto trading volume just exploded, up a staggering 480%. And they pulled in $5.6 billion in new deposits. I mean, these are just incredible numbers by any standard. So why the huge sell-off? Here's the thing. A stock never exists in a bubble. First off, there was a much bigger sell-off happening across the whole tech sector, and that just dragged Robinhood down with it. Second, it could be a classic case of sell the news. The idea is that the stock had already climbed up because everyone was expecting good news. So when it finally came out, traders just took their profits and bailed. And lastly, there were some reports of top execs selling off stock recently, which always makes investors a little jittery. It was really a perfect storm, where all that market noise just completely drowned out a really positive signal from the company itself. Okay, so from that puzzle, let's shift gears because the drama was just as intense over in the streaming world. And here we've got this fascinating tale of two giants, Netflix and Disney, who seem to be heading in completely different directions on Friday. And it all kicks off with this massive question. While a ton of other tech stocks were in the red, all the buzz around Netflix was about a potential buyout that could literally reshape the entire entertainment industry. So the rumor mill is churning, and the big story is that Netflix is getting ready to make a bid for Warner Bros. Discovery. We're talking about the home of HBO, CNN, the whole Warner Bros. Movie library. This is huge. And they'd be up against other heavyweights like Paramount and Comcast with a supposed deadline of November 20th. This also comes right as Netflix is playing around with its gaming strategy, which just shows they're always thinking about what's next. It's all about the future. Now, contrast all that excitement about the future with what was happening over at Disney. While everyone was talking about Netflix's next big move, Disney's stock was getting hammered, falling somewhere between 7 and 8%. And the reason was all about looking backward at their last quarter. And this slide really lays out the two-sided story in their earnings report. The good news? They got more streaming subscribers than Wall Street was predicting. Awesome! The bad news? Their total revenue for the quarter missed the mark, and even worse, their forecast for the future, what we call guidance, was pretty weak. And for the market, that weak outlook was the only story that mattered. But, despite that gloomy forecast, you had CEO Bob Iger trying to paint a picture of long-term vision. He kept talking about this incredible opportunity to use AI all across Disney. This quote really shows you the disconnect. The market was stuck on today's numbers, while management was trying to get everyone to look at tomorrow's tech, a real battle between the present and the future. But, hey, it wasn't all doom and gloom. Let's pivot to a much happier corner of the market. Because while all the big tech and media companies were having a rough day, one specific part of the retail world was having an absolutely fantastic day, proving you can find momentum anywhere. First up, we've got the Swiss performance brand On Holding. The stock didn't just have a good day, it rocketed to a brand new 52-week high. Now that's the kind of strength investors love to see, especially when the rest of the market feels so shaky. And they weren't alone. Right there with them was Deckers, which is the company behind Hoka and UGG. They got this huge vote of confidence from Wall Street, with one analyst jacking up their price target on the stock to a massive $1,100. So what's the deal? What's driving all this excitement? Well, it really just comes down to good old-fashioned execution. For On Holding, this momentum is coming straight from an amazing earnings report they put out just a couple of days ago, where they crushed expectations and raised their forecast for the whole year. And for Deckers, it's all about the sheer power of their brands. That analyst upgrade specifically pointed to the incredible growth they're seeing in both Hoka running shoes and their classic Uggy boots. Just a simple story of selling stuff people really want. Okay, for our final segment, we're going to pull back the curtain a little bit. Because away from the flashy headlines and the big market swings, there's this steady stream of official paperwork that can tell you what's really happening inside a company. We're talking about SEC filings. So what even is an SEC filing? The easiest way to think about it is like a company's official public diary. It's a document they are legally required to share, and it's where you find the raw facts, the deep financial details, any big corporate changes, or shifts in who owns the company. They're an absolutely essential tool if you really want to know what's going on. And on Friday, we saw a few notable ones. Zillow filed a 10Q. That's basically the super detailed version of their quarterly report card. News Corp filed an 8K, which is like a breaking news alert for investors that something big and unscheduled just happened. And then Lemonade had a 13G filing, which showed that a major investor, SoftBank, had changed its ownership stake down to 4.8%. See, each one tells a totally different but important piece of the story. So, after going through all of that, the tech troubles, the streaming drama, the retail winners, what's the one big thing we should take away from a day like Friday? It really boils down to this. In a market this complicated, your most important job is to figure out how to separate what's truly meaningful, the signal, from all of the chatter and fear and day-to-day distractions, which is the noise. Let's just quickly recap. We saw that amazing data doesn't always equal a rising stock, right, Robinhood? We saw how a big story about the future can completely overpower a story about today, like with Netflix and Disney. We found these awesome pockets of strength where niche leaders like On and Deckers just ignored the chaos and kept on winning. And we learned that sometimes the real story, the important signal, is buried in the paperwork. And that kind of leaves us with one last question to think about. On a day with so many conflicting headlines pulling you in different directions, it forces you to decide which stories are the real lasting signals and which ones are just temporary noise. So in a market like this, what's the story you're choosing to follow? Thanks for tuning in.